In this lecture, we'll continue our discussion of revenues and taxation. In the previous lecture, we were discussing the principles of taxation, and we discussed two of these principles, the revenue potential and the equity of the tax. And today we are going to discuss the remaining four principles of taxation. The third principle of taxation is economic efficiency. So when decision makers look at tax policy or the design of particular taxes or estimating revenue potential of a particular tax, one of the things to consider is the potential of the tax to distort economic behavior or to affect the allocation of resources within the economy, or even to affect the choices consumers make or the choices people make or the behavior of people. For example, in response to let's say the income tax, so people might, if the income tax becomes very high, people might start trading off work for leisure, so people might decide not to work extra hours and instead take more time off and take more vacation, because the higher the tax rate goes, especially those at the very high income or the very high income earners, or those who are taxed at the highest bracket, if incomes become very high, and in some countries the income taxes have reached 40%, but beyond these levels, if countries go beyond 30 or 40%, it might change people's behavior, and people might decide that it's not worth it to work the extra hours if they are going to be taxed beyond 30 or 40%, or even at 50 or 60%. This would be too high. So decision makers would need to make considerations or take into account how the tax rates and the tax policy might affect people's behavior with respect to uh, economic activities and even consumption activities. So choosing between commodities, if some commodities are taxed and some are not, or some have higher taxes than others, so this might change people's behavior in terms of purchasing some items that are taxed less than others where there are higher taxes. Also, the choice between consuming and saving. So, for instance, introducing or raising sales taxes might reduce, for example, consumption, because when you apply a sales tax, usually the consumer who bears the cost, so the cost of commodities becomes higher, and so people's purchases might be reduced, and so consumption might be affected. So all of these considerations are things to take into account when decision makers think of tax policy or estimate revenue behavior. Sometimes some taxes are designed to specifically change behavior. So let's think of the taxes on cigarettes, for example. The intention of this might be to actually change people's behaviors and in a way persuade or try to reduce the amount of young people to avoid smoking even before starting smoking. So the higher and higher the price of cigarettes, it might be unaffordable for a number of of the young people, and so by that it might in a way attract less young people to smoking because of its high price. So sometimes changing economic behavior or distorting behavior, changing behavior, is an intentional policy of a tax design. The fourth principle of taxation is what we call collectability, or the cost of administration. So this is the cost of administering the tax and collecting the tax and enforcing the tax law so as to collect the tax revenue. And so here, governments, or the cost of the tax is usually thought of as being a loss to society, because whatever is spent on tax collection is not really spent on providing a service or an activity or a good to the public. Instead, it is just an administrative cost that is being paid for in order to be able to collect this amount of revenue. And so ideally, governments would want to have taxes, or to avoid taxes that have a very high cost, especially if they do not generate a sufficient amount of revenue. Some taxes can be costly to administer, but still the tax yield is large enough to incur the cost. So it's really a balance, or it's really the cost of the tax versus the amount of tax yield that you're generating. So if the tax, or if the cost of the tax is very high or exceeds the amount of income or tax yield that can be generated from the tax, then it's not really worth it to collect this tax. So ideally, even if you have a cost for administering, having structures, having employees, having evaluations, or yearly evaluations, or whatever, or some accounting, some special use of accountants, or whatever the cost that is being paid for the collection of the tax, this tax cost should not exceed the amount of tax yield that the government is expecting to generate from this particular type of tax. And here we usually have two types of costs. So uh, an initial cost for making a structure for the tax, and designing the tax code and the tax structure, and setting up the structures, and the and making the necessary infrastructure for having the tax, or collecting the tax, whether you have employees, whether you make training for people, employees, to be familiar with the new taxes, or whether it's the locations or buildings where you collect the tax, whether it's electronic infrastructure for filing taxes electronically. So there is an initial cost to the collection of the tax, and there is also the enforcement of the tax year after year. So the cost for collecting income taxes or property taxes year after year. So these two costs need to be considered when evaluating taxes, or when thinking about which taxes, or whether a tax is costly to administer or not. And usually there are costs can be bared by the government, or by the taxpayer, or some intermediary or third party. So for example, income taxes, there might be a cost for the taxpayers, for example, who have to maybe hire accountants, or get some help with filing taxes. There is also a cost for government, because usually the government would have to have offices for collecting of tax papers, auditing these papers, and so on. So there is cost to government. There might be a cost to the taxpayer. Sales taxes, for example. Sales taxes, eventually, as we'll see, usually sales taxes, they're eventually paid by the taxpayer. When you purchase something, you pay for the product, and you pay for the sales tax as well. So it's the taxpayer who pays the sales tax. However, businesses, or corporations, or stores from which you buy the services, they too have to abide by the tax code. So in essence, they are collecting this tax money, or this amount of tax, from the purchaser or the taxpayer in order to pass it on to the government. So there might be an additional cost here to an intermediary, which is the business or the store or the person who offers the good or the service, so that they would have the accounting system and the calculation of the sales tax and whatever, so that they can collect these taxes from customers and pass it on or pay it to government. So in this case, there might be an additional cost to businesses in this respect, whereas they are not the beneficiaries of uh, the tax, because eventually this tax goes to the government, but they still have to bear some of the costs. So it's very important also when understanding taxes and the cost of taxes, and whether a tax is costly or not costly, it's easy to administer or not, is to look at what are the costs of these taxes and who actually pays these costs. The fifth principle of taxation is political feasibility. That is, whether the taxes can be enacted in the current political environment. So some taxes, or you, when considering changes in the tax codes, when considering changes in tax policies, raising tax rates or enlarging a tax base or whatever, one of the considerations that need to be considered, or one of the things that decision makers take into account, is the political feasibility of this tax. Can we impose this tax? So, for example, proposals to raise the income taxes during times of economic recessions is usually politically unfeasible, simply because people are already suffering from low incomes. Perhaps there are uh, people losing their jobs, their incomes are not increasing, so thinking of raising tax rates will not be possible. For example, here in Egypt, uh, in, in some countries there are taxes on, for example, interests gained from saving your money in the banks. In Egypt, this is not politically feasible. This is not an existing tax, and it is not politically feasible simply because, for one, a lot of people rely on saving their money in their banks, and this becomes their main source of income for maintaining their living standards. You have a policy where government encourages people to save money in banks as opposed to saving them at home. There is so there is a tendency for, not having a tax on savings, especially bank savings, and these types of taxes. In other countries it might be politically feasible to have these types of taxes. So this is also context specific, what is acceptable and what is not acceptable in some countries versus others. Usually, if you don't have a tax, like if you didn't have a particular tax, it's usually the introduction of a new tax is usually a critical decision. And so governments usually have to think about whether they can really impose this tax or not. Generally, however, some taxes are less popular than others. So, for example, property and income taxes are usually less popular than sales taxes or user fees, uh, because usually because of what we call maybe the benefit principle. Because with sales and user fees, what you pay for is usually you get something in relation to what you pay. So you're in a sense paying for the service. Even with sales tax, if you don't want, it's a consumption tax, so if you don't consume, if you don't buy, you will not pay it. However, income and property taxes are obligatory. In a sense, you have to pay the tax, or it can be deducted from your income, or whatever the means by which government collects the money, but you have to pay the tax regardless of the amount of goods and services that you get in return for paying the tax. And usually, or in the general trend is that people usually, or because we do not have a direct match between what we pay and what we get in services, usually citizens, we have a growing demand for more government spending, for more government services, for more government involvement in activity, providing services, improving communities, building roads, paving roads, building schools and hospitals. However, we citizens generally have a less tendency or do not want to pay more taxes in return for these services. The last principle of taxation is transparency. So, to what extent is the overall administration of the tax or the overall collection of the tax is transparent or is made public and people are or taxpayers are aware of it? So the adoption, so whether people were aware of the tax law, the existence of the tax, the existence of the tax codes, the provisions of the code. Do we have as citizens complete information about how this tax is being calculated, or how are we, or how the government calculates our liability, that is how much we have to pay, uh, in a clear manner. So do we have enough information about how the calculation, or how the amount that I pay in tax as a citizen is determined, and how this tax that I owe was calculated and was calculated and determined by government? So do people have this type of information? Was it also enforced in a clear manner? Do we have means of telling whether it was fair, so people in equal tax positions are paying the tax equally, or equally paying the tax? Is there a way to appeal the process if I think that I paid more taxes than I should, if I think that the evaluation of the tax, or the amount of tax that I owe to government is not correct, or that it was not properly the tax was not properly calculated or evaluated? Is there means by which I can appeal the process, or say this was not correct, I demand a reassessment or a recalculation of my tax? Uh, and also, do we really know how much we pay in tax? So sometimes, especially for people who are on employment, or people who work in, whether in government or in the private sector, the administration of the income tax usually takes the form of a deduction from your pay. So what you get at the end is your salary after the taxes have been taken from your income. So usually this, in a way, people become unaware of how much money has been really taken from their income, because unless you have to go back every month, check your salary sheet and look for how much has been deducted from your salary every month, and have a calculation of that amount every year, and do a calculation of the tax upon which you have been or the tax rate or whatever. Some people may not be aware of how this money has been taken from them, how this money has been calculated. Also, the complexity of the tax code, the more the complex it is, the more it makes it harder for people to understand the tax code, to understand how this money has been taken from them, to understand how assessments of uh, their property taxes has been determined, for example. So the more the tax system or the tax code is easy, is made public, with clear steps as you how uh, as to how government makes these assessments, collects the tax, makes or imposes or asks you for this amount of money, the more the transparent and open the system is. The opposite, of course, means you have a less transparent way of knowing how much you owe, how much you pay in taxes, and how this tax has been collected.